I'm going to flag just a few important charts, just talking about a few fulcrums, these kind of ideas of real big pivot points within markets of what could be important movers. And this to us is probably the most important story in all of markets. And it's that we are living in a very different world for growth expectations. We've been calling the two charts on the left, so the first and the second chart, the most important charts in markets over the last 2 years. The last 2 years have been defined by rising growth forecasts for the US economy. The US economy defying expectations to the upside, defying recession calls, and having this continued growth forecast being ratcheted up higher and higher and higher. That provided the backdrop for very strong returns for both equities and credit. Risk assets love forecasts going up. But this is very different today. Look at forecasts on the far right chart. They have fallen off a cliff. And those forecasts falling off a cliff reflect the economic reality that tariffs could weigh on growth. But probably even without tariffs, forecasts were likely too high given some of the dynamics and details that we outlined in our outlook, where some of the tailwinds to growth that we had in 23 and 24 were clearly fading. So this is a very different, brave new world when it comes to growth forecasts. The other important thing that feeds into this growth forecast and what we think is going to be a major kind of tilting shift of where this economy goes is where corporate margins go. We've been in a world where corporate margins have been extraordinarily resilient, making new highs. Of course, 2021, 22, getting to new highs thanks to inflation. Corporate margins were great in those years because there was inflation that could be passed on to consumers. And so one of the challenges we see for corporate margins is that as consumers have less ability to stomach higher prices, to take on those higher prices from companies, companies are likely to have to absorb more of those costs onto their operating margins, which just means that the consensus forecasts for new record margins in 2025 and 2026 look to be too aggressive. Two more quick things from me is one is on the dollar. We've seen distinct dollar weakness. And of course, this has come with the narratives of the end of US exceptionalism. And there's an interesting observation here, which is that the first half of the move of the dollar lower was really driven by positioning in futures. You started the year with a very crowded US long dollar position. That has now unwound, and now you're at a position where traders are slightly short dollars. But what you can see in that red line is we have undershot to the downside this dollar positioning in the futures market. It suggests that maybe there is dollar weakness coming from drivers of sellers in other places. It could be a function of the fact that if we are trading less, we have less of a capital surplus, which means that there's less demand for dollars. This, of course, has really important implications about the leadership within equity markets on a global basis. The only time you see big, huge bull markets in non-US stocks is when you have big, huge bear markets in the dollar. And so it's one of our reasons why we think that having a diversification between US stocks and global stocks remains a really important part of portfolio construction. So one last thing is just talking about treasury yields and the question of, are they decoupling from the growth outlook? Here you can see that treasury yields have been very strongly correlated to economic surprises. Economic data comes in weaker than expected, treasury yields go down. Economic data comes in better than expected, treasury yields go up. But over the course of the last week, you saw a big jump in treasury yields, but you were seeing deterioration in economic data. This suggests that there was certainly some positioning drivers. We saw some unwinding of some leveraged hedge fund positioning and swap spreads. We also saw potentially, there's theories that you are seeing some sellers of treasuries, and we'll talk about that in a second from foreign buyers, but you're also seeing potentially concerns about the fiscal situation in the US, given interest costs are now starting to eat up more and more of the US deficit, something that Brian can talk about as well in the policy section. So clearly, we have a lot of volatility within the treasury market, and we don't expect this to end. So one last note just on that question of treasury yields decoupling is that there's a lot of talk and narrative about what's going on with China selling our bonds. So this is data through the end of the fourth quarter 2024, and this is data that captures the treasury holdings from different holders across the globe. What you can see is that Japan is the biggest owner of treasuries, even though it used to be about 10 years ago China. But for the last 10 years, China has been reducing its treasury allocation and reducing its overall size of treasury holdings. And so this is nothing new for China to be selling treasuries or not reinvesting as much as in treasuries. But again, this is only through the fourth quarter. So it'll be very interesting to see if there is a sharp downtick within Chinese treasury holdings in response to what's going on the trade front. The one thing that we would talk about, though, is that if you look at where there's been big buyers of treasuries, it's been in the UK and Canada. And both of those areas are big question marks. If we're trading with them less, will there be as much demand for treasuries going forward? Big important questions as we move through the rest of the year, but it's important to kind of at least acknowledge that the story about China selling treasuries has been something that's been going on for more than a decade.